In 1897, Sears published a catalog that changed America. You could order almost anything: furniture, clothing, tools, bicycles, musical instruments. You could even order an entire house in kit form. Sears would ship you the lumber, the windows, the hardware, and the instructions. Sears was Amazon 120 years before Amazon existed. At its peak, Sears had over 3,000 stores and employed 350,000 people. Then, one hedge fund manager decided to run it like a financial portfolio, and 86,000 people lost their jobs. Richard Warren Sears was a railroad station agent in Minnesota in 1886 when he started selling watches by mail. Within a year, he had partnered with a watchmaker named Alva Roebuck and founded Sears, Roebuck and Company. Their insight was simple. Farmers and rural Americans were being exploited by local merchants who charged inflated prices because customers had no alternatives. A mail order catalog could bypass those merchants entirely. By the late 1890s, the Sears catalog was over 500 pages long. The company was shipping millions of packages per year to customers across America. By the 1920s, Sears transitioned from pure mail order to retail stores, opening locations in cities as car ownership spread and people could travel to shop. This was one of the earliest examples of a company successfully pivoting its business model in response to changing consumer behavior. By the 1970s, Sears was the largest retailer in the United States. The Sears Tower in Chicago, built in 1973, was the tallest building in the world. The decline began gradually in the 1980s. Walmart and Target were expanding aggressively with a different model, one focused on low prices and operational efficiency. Sears was a department store that tried to sell everything to everyone. The focused discount retailers were better at selling many of the same things at lower prices. In 1993, Sears made a significant strategic error. They discontinued the iconic Sears catalog, the same catalog that had built the company. They said it was unprofitable and that the future was in retail stores. But the catalog had been the company's connection to customers who could not easily visit stores. That same year, a small internet company was looking for retail partners. Sears passed. The opportunity was Amazon. In 2004, Eddie Lampert orchestrated a merger between Sears Holdings and Kmart. Lampert was a hedge fund manager from Greenwich, Connecticut, whose fund ESL Investments held major positions in both companies. He had no experience running retail operations. He had a lot of experience in financial engineering. His theory was that Sears and Kmart's combined real estate holdings were worth more than the market was giving them credit for. By unlocking that real estate value, he believed he could generate enormous returns for his fund. The theory was correct. The execution destroyed everything it touched. Lampert divided Sears and Kmart into 30 separate business units, each run as an independent entity with its own profit and loss. The theory was that internal competition would make each unit more efficient. The reality was catastrophic. Each business unit was judged on short-term profitability. No unit would invest in anything that would hurt current quarter results. The appliances unit would not help the tools unit promote a sale because the appliances unit did not benefit. The stores unit would not share customer data with the online unit because sharing data was a cost, not a revenue. The plumbing in stores was deteriorating. The lighting was dim. The inventory management was failing. Nobody fixed anything because fixing things was a cost that would hurt the quarter. Lampert was focused on the real estate. As stores failed, his fund could buy the real estate at advantageous prices through related party transactions. He was essentially profiting from the company's decline while running the company. Between 2005 and 2018, Sears and Kmart closed over 3,000 stores. The company lost $12 billion over that period. When Sears finally filed for bankruptcy in October 2018, Lampert submitted a bid to acquire what remained. His fund put up $5.2 billion to acquire the brand, the remaining stores, and the intellectual property of the company he had systematically dismantled. The bankruptcy judge approved the sale over the objections of the pension funds and employee groups who argued the deal was improper. 86,000 employees lost their jobs. Retirees who had worked for Sears for decades saw their pension benefits reduced. Lampert's ESL Investments was later sued by the Sears bankruptcy estate. The lawsuit alleged that Lampert had extracted billions from the company through dividends and stock buybacks that benefited his fund at the expense of creditors and employees. The lawsuit was eventually settled for approximately $175 million. No criminal charges were brought. The Sears story is not primarily about Amazon or e-commerce. It is about what happens when a company that needs to invest in its future is controlled by someone who profits from its decline. Lampert needed Sears to invest heavily in technology, store renovation, and e-commerce. Instead, he used the company's cash for stock buybacks that benefited shareholders, including his fund, and dividends that extracted value from the business. The stores that customers visited got worse every year. The technology fell further behind Amazon and Walmart. The employees who showed up every day watched the company deteriorate around them and could do nothing. Sears was Amazon before Amazon. Then it was a case study in how not to run a company. And then it was nothing.